guys, David Wilmot here for another weekly market update. Hope everyone had a good week. Want to kind of just look over a couple of things that I've been seeing, some fun stuff happening in the markets, and not so much anything specific, but just some things I'm looking at that I felt like would make sense to bring to your attention. So let's start by that. All right, the biggest one, and this is just a huge just throwback to 2021. But the biggest story that I'm looking at this week is that GameStop is not the biggest story, but definitely the funniest story and something worth always paying attention to is that GameStop decided to go on a run again. So at the start of this week on Monday, we were trading down at $17 a share. 2 days later, we closed at 48. We opened as high as like in the 60s that this got to. Anyway, stock is back. All these questions about whether the short squeezes were closed out. Nothing meaningful here. This is not something that there's no reason to speculate in markets. It's really about buying and holding qualities long term. But this was just a name that dominated the news headlines 3 years ago. And it's great to see it come off another run up again. It really just prompted all those memories back in 2021, seeing everyone kind of go into it from there. So today is May 14th. Tomorrow, the 15th, the CPI data is going to be released. But some information that came out today is PPI, which stands for Producer Price Index. Okay, and the PPI and the CPI really kind of move hand in hand. So it came out today, and unfortunately, PPI it rose. So what this is really showing, and maybe kind of alluding to what's going to happen by the time you see this video, we'll see tomorrow, is that that inflation is still rising. The cost of goods and services are going up. This Twitter account that we're following here, they say here yet another sign that the Fed can't cut rates. So if you've been listening to the Federal Reserve Chairman Jerome Powell and others speak, they need to see inflation come down to what they want at 2%. I always joke that 2% is enough that Americans don't realize they're getting robbed. But jokes aside, the goal is a 2% target. And with PPI still elevated, there's all reasons to say that tomorrow the CPI data is going to come back in and it's going to be hot and it's going to be higher from there. So costs and goods and services rolling up, and it really puts the Federal Reserve, and the Treasury in a pinch, right? So something else, another headline that came out was that Janet Yellen admits that higher interest rates make the fiscal challenge worse. So, we flash back to in the 1980s, Paul Volcker comes in and really kills inflation and kills the recession we're in he causes a recession by jacking up interest rates. Back then you could get a CD for 18%, mortgage rates for 15%. Ask your parents about it, right? But that really ultimately ended up killing inflation. The reason we can't do that right now is that the national debt's at $34 trillion. So, with interest rates this high sustainably, now interest rate payments on the debt end up eating into the cost of our budget. It's all these nightmares associated with it. So bottom line, inflation still being high and leading to what the Fed is going to do with rate cuts. It really puts us in a bit of a lose-lose situation right now as we try to go into the year. Inflation is still high. We can't lower rates, but we're going to need to cut rates. So I'm going to show you one more thing here, and maybe an actionable item for you to work with. So this is from JP Morgan's Guide to the Markets. This is all free public information. If anybody wants to go on to JP Morgan and check out Guide to the Markets, they can. But what we have here is this is what the Fed and interest rates are going to do. So this is the federal funds rate. So they've jacked it up from 0 to 5.8%, and we've been holding flat since June. I talked about this in the last market video. So we have the green here is what the bond market is predicting they're going to do. We have the blue, which is what the Fed is saying they're going to do. And then the purple is still the long-term average here. No matter which way you cut it here, we're looking at interest rate cuts coming within the next 12 to 18 months. When, how many, these are all yet to be seen, okay? And this chart really kind of tells a story here, right? We have 2001, for example, the last time Fed cut interest rates. This was the dot-com crash in 9/11, right? We flash forward to 2008. We have the market crash in 2008. And then we have at the end of 2019, beginning of 2020, we have COVID. So this actually chart tells a really interesting story here, all right? The last piece I want to show you from this. So interest rates and bond prices work like a seesaw. Okay, so when interest rates go up, bond prices go down, and vice versa. When interest rates go down, bond prices go up. Right? We saw this in 2022 was one of the worst years for bond markets ever. Interest rates shot up so quickly from 0 to 5%, a lot of bond prices and portfolios fell drastically. And we saw a lot of people who were quote unquote conservative actually had a terrible year in 2022 because of their bond portfolio getting wrecked, right? But I want to show you this chart on the right here, which shows an impact of a 1% rise and fall in interest rates. Okay, so this will show you what the price of a bond will do if interest rates were to go up another percent from here, as we see in gray, and the blue is what we see if we lose an interest rate, right? So the good news is almost all bond prices have a tremendous upside, but 30-year longer duration you take on a bond, we might see a bit more volatility. But I really want to focus in on corporate bonds here, investment grade corporate bonds, right? If interest rates were to rise 1% from here, the prices of these bonds would stay relatively flat. But if they were to fall by 1%, we're looking at about a 13% growth in the price of bonds. And with interest rates being as high as they are, this really puts you as a win-win investor. You can buy a corporate bond right now, 5, 6, 7% over a 10-year period and get a phenomenal coupon. And if interest rates fall, the prices of these bonds are going to grow exponentially, right? And if we go back to this father chart, both the market and the Fed, and even the Fed's long-term run here, all signs are pointing that interest rates are going to be coming down in the coming years. So just some actionable advice, something to think about there. We'll check back on that in a couple months and see where we shake out from it. But at the end of the day, guys, that's this weekly market update. I hope you guys have any questions, comments, concerns. Don't comment, shoot me a message. I'll be happy to help out, and you guys have a great day.